Welcome to the Deep Dive, your essential shortcut to gaining thorough knowledge quickly. Today, we are undertaking a critical analysis of a company that embodies one of the great financial paradoxes of our time. Evolution AB, or EVO, we're looking at the undisputed B2B king of the global online casino industry. I mean, this is a business that controls a near monopoly in the high-growth live casino space and which boasts absolutely phenomenal world-class profitability.
Yeah, we're talking EBITDA margins that sit comfortably north of 65%. It's pretty incredible.
Exactly. So you'd expect this to be a perpetual stock market darling, right? Yet, after an explosive run, say between 2017 and 2021, the stock price has essentially spent the last couple of years stalled, just trading sideways. It's left a lot of investors scratching their heads.
It really is the ultimate puzzle for any serious analyst, and it's the core tension waving through all the sources you've shared with us. How does a dominant, cash-gushing compounder, a business that enjoys this profound operational and margin advantage, consistently, 2,000 or more basis points higher than its nearest publicly traded peers, how does it see its stock tread water for years?
So what's the market consensus saying? Why the stagnation?
Well, the common explanation currently priced into the market, the one causing this valuation stagnation, it really centers on three key anxieties. First, the undeniable fact that the hyper-growth days, the 50% year-over-year expansion, that's history now.
Okay, slowing growth. What else?
Second, there are perceived regulatory headwinds, particularly in the historically lucrative European markets. And third, there's this fear that the core live casino business might be maybe prematurely maturing.
Right. So our mission today is clear. We need to separate the short-term noise and these transitional challenges from any fundamental long-term structural decline. We're diving deep into the contrarian thesis here.
And that thesis argues that the current slowdown isn't a sign of structural failure at all. It's temporary, partly self-inflicted, and actually quite strategic.
Creating what the sources call a rare opportunity to buy a category-defining leader at a historically reasonable valuation. So we need to figure out, is the market correctly predicting a necessary deceleration, or is it entirely misreading a complex transition phase, potentially offering patient investors a substantial return path? Okay, to really appreciate where they are now, their position of strength, we have to start at the beginning. Let's examine the foundation of this business. The origin story of Evolution, founded back in 2006 by Jens von Baar and Frederick Osterberg, it's fantastic because it's based on a single, really powerful insight.
Yeah, and that insight was simplicity itself, really. The burgeoning online gambling world in the mid-2000s, it was dominated by computer-generated random number generator games, RNGs, basically digital slot machines, automated tables.
Oh, very mechanical.
Exactly. And the founders realized that what was entirely missing was the human element. Players missed the trust, the social interaction, the authentic, maybe even glamorous atmosphere of a real casino floor. They needed to bridge that gap.
And their solution was pretty revolutionary at the time, wasn't it? Using streaming tech to deliver an authentic live gaming experience, but doing it at like an industrial scale.
Precisely. Their first major studio was set up in Riga, Latvia. And this wasn't just a few webcams pointed at a table. They were building high production value television studios, essentially, disguised as casino floors.
And there's that famous detail about proving it was live.
Oh, yeah, it underscores their focus on trust, which is just the cornerstone of their brand. In the early days, they famously kept a BBC newscast running visibly in the background of their live roulette streams.
Just to prove it wasn't pre-recorded.
Exactly. To prove to skeptical operators and, crucially, to the players that the feeds were truly live, unedited, that intense commitment to transparency and quality, it immediately differentiated them. Live casino, almost overnight, went from this niche curiosity to an absolutely essential category for pretty much every reputable online operator globally.
Okay, so what's really essential for you, the listener, to grasp here is that Evolution is not the casino operator. They are the infrastructure provider.
That's key. They don't bear the high cost and complexity of acquiring the actual player base or managing that customer relationship, which often involves significant compliance and, heavy marketing spend.
They're the supplier, the picks and shovels provider for this whole digital gold rush.
That analogy is perfect because it highlights their risk profile. They're the low-risk utility, not the high-risk cyclical prospector, if you will. They build and operate these massively sophisticated studios. Think of them as digital broadcast centers. They hire and train the, 22,000 plus professional game presenters. They develop the proprietary streaming tech.
And then they license this entire turnkey solution.
Exactly. They provide it to over 800 global operators, including the real heavyweights like DraftKings, Flutter, Bet365, 888. This pure B2B model is the absolute strategic foundation for their spectacular margins.
And the scale is just mind-boggling.
It is. They were running 20 or more massive studios globally, managing over 1,700 live tables concurrently. They need that scale just to serve the peak demand curves of a global audience spanning every single time zone.
Let's break down those revenue segments quickly because they're definitely not created equally. Live casino is, well, it's the crown jewel, right? Accounting for about 86% of reported revenue as of Q2 2025.
Undeniably. This segment covers the classic tables, your blackjack, baccarat, roulette, but their real masterstroke, the thing that changed the game, was creating an entirely new category: the live game shows.
Ah, yes. The game shows, Crazy Time, and all that.
Exactly, starting with Dreamcatcher back in 2017, and then these blockbuster hits like Crazy Time and Monopoly Live. This is crucial because this is where they moved beyond just replicating the physical casino experience. They started creating original, high-variance entertainment designed specifically for a younger, more digital native audience.
So that's their most valuable IP.
Arguably, yes, and it's where their competitive moat is probably deepest.
Okay, so the remaining chunk of revenue comes from RNG, the digital slot segment.
Right, the remaining 14%. And this RNG segment was built almost entirely through highly aggressive strategic acquisitions: NetTint, Red Tiger, Big Time Gaming, No Limit City.
They basically bought the competition.
Well, yes, and the motivation was twofold. First, to become a truly comprehensive one-stop shop, or OSS for operator, making them an indispensable single integration point for all digital gaming content.
Makes sense. And the second reason?
Second, and maybe even more importantly, it was a brilliant defensive move. It prevented a competitor, especially one with deep pockets, from acquiring those valuable IP portfolios and using them to challenge Evolution's overall dominance. They essentially bought the competition to strengthen their own moat.
Smart. Now let's talk about the revenue engine itself, because the dynamics here are really key to understanding their cash flow, aren't they?
They are, and it's elegantly simple and incredibly scalable. The vast majority of their income, typically about 10%, though, it varies by contract, is a usage-based commission. They take a revenue share on the operator's gross gaming revenue, or GGR, generated specifically by their games.
So their interests are aligned with the casino operators.
Perfectly aligned. Evolution only succeeds and grows when their games are popular and highly successful for the operator. Secondly, for their largest Tier 1 clients, they also offer fixed fees for bespoke, dedicated, and branded tables.
Oh, okay. So that adds a layer of stability.
Exactly. It provides a stable, recurring revenue stream and significantly enhances operator lock-in. Makes it harder for them to switch.
And the beauty, as you mentioned before, is the operational leverage.
Absolutely. Think about the cost structure. The most significant costs are fixed capital expenditures: building the studios, buying the equipment, training that initial cohort of dealers. Once that infrastructure is built, once that table is live and streaming 247,
The cost of adding more players is tiny.
near zero, practically. The incremental cost of servicing 1,000, 10,000, or even 1,000,000 more simultaneous players is negligible. So those fixed costs of infrastructure and labor get spread across a massive and rapidly growing global revenue base. That compounding dynamic is the engine. That's what drives those almost unbelievable 65, 70% EBIT margins year in, year out.
Okay, so we've established this isn't just a good business. It's really an infrastructure business built on this incredible foundation of operational leverage. But the real question is it defensible? High margins always attract competition.
Always.
The sources argue that Evolution's competitive edge isn't just one thing, but a highly resilient, systemic fortress of interlocking moats.
This is really the deepest part of the deep dive, I think, and it's why, structurally, the market probably should value this company higher. Moat number one is just unmatched scale and cost advantage. We keep mentioning the margins, but we need to really understand what that 65, 70% EBITDA margin actually translates into competitively.
It's way higher than anyone else.
It's 2,000 plus basis points higher than any real competitor. Light & Wonder sits around, 44%? Playtech, maybe 32%?
So that extra 20 percentage points of margin, that's essentially a competitive weapon.
It's a phenomenal weapon. It gives them the ability to, say, underprice selectively if they have to weather any potential price war. And most importantly, it allows them to reinvest far more aggressively into R&D, into innovation, into new studio builds.
Than all their competitors combined.
Pretty much, yeah. So a new entrant Even one bankrolled by, I don't know, a tech giant, faces an economically almost impossible task. They'd need to burn hundreds of millions, maybe billions of dollars just to replicate the current global studio network.
And they'd be doing that while competing against an incumbent whose marginal costs for serving new players are basically zero.
Exactly. The incumbent advantage is just insurmountable because the starting line for replication is too far away and way too expensive.
Okay, so that structural cost advantage, that feeds directly into the second moat.
Mm-hmm.
The powerful network effects, right? The two-sided flywheel that drives the whole ecosystem.
That's right. On one side, you've got the players. They're drawn to online casinos that offer the best, most engaging, and most unique content. In the live casino space, that uniquely means Evolution's portfolio, particularly those smash hit live game shows we talked about.
Like crazy time.
Exactly. Operators must feature Evolution's content to attract and, critically, to retain their user base. If you don't have crazy time, your players will just churn to the site that does.
So it's a virtuous cycle. Operators need the games to get players. Players want the games Evolution provides.
Precisely. This virtuous cycle forces nearly every operator to integrate Evolution's product.
And that flywheel doesn't just generate revenue, it generates data. Proprietary data.
Huge amounts of it. Every spin, every bet, every new game launch generates billions of proprietary data points on player behavior, risk appetite, entertainment preferences, you name it. Evolution feeds this data right back into its R&D process.
Allowing them to innovate better and faster than anyone else.
Exactly. Which further strengthens the product advantage and widens the gap between them and any potential competition.
Okay, moat number 3 ties directly into that network effect. Switching costs, or as the sources put it, it's basically commercial suicide for an operator to switch off Evolution.
Yeah, for a major Tier 1 operator, removing Evolution's most popular content, those key player attractors, it's just commercially irrational. The loss of revenue would be immediate and massive as players simply migrate to a competing site that still offers them.
And this stickiness is reinforced by a couple of things.
Right. First, long-term contracts, typically running for 3 years. And second, the deep technical integration required to embed the live casino streams into the operator's platform. It's not just a simple plug-and-play solution. It's a deep integration that makes ripping it out prohibitively disruptive and costly.
Moat number 4, which we touched on earlier, is innovation and IP. They aren't just selling a video feed. They're selling unique, often patented, copyrighted entertainment experiences.
This is absolutely critical, and the sources highlight some recent moves as potential game changers. Evolution's focus on creating entirely new categories, moving beyond just standard card games, continuously differentiates them. But maybe the most significant IP move to date is that exclusive global licensing agreement with Hasbro.
Right, starting in 2025.
Yeah, set to begin rolling out soon. This provides them with unique world-famous IP like Monopoly, which competitors simply cannot replicate in the live casino space.
I have to ask, though, why is licensed IP, like Hasbro's, potentially so much more important than their own internally generated IP, like Crazy Time?
That's a really sharp question. Crazy Time is phenomenal, obviously, but it required marketing and time to build that brand recognition. Hasbro's IP Monopoly, Clue, whatever they use, it's instantly trusted, instantly recognized, and has universal appeal.
So the friction for a player to try it is much lower.
Near zero, exactly. When a player sees a Monopoly live game, they already have this decades-long relationship with the brand. This dramatically enhances player acquisition and retention for the operators, which in turn makes Evolution's product even more indispensable. It's an IP moat that is both wide and instantly recognized globally.
Okay, and finally, moat number 5. This is the very thing the market seems worried about: regulation. The sources actually argue that regulation, while creating some short-term anxiety, acts as a long-term barrier to entry.
And this is a nuanced but really important point. Acquiring the necessary operating licenses in complex, tightly regulated jurisdictions, think New Jersey, Michigan, the UK, and now the newly regulated Philippine market, it's incredibly time-consuming, it's expensive, and it requires a absolutely pristine compliance track record.
Something smaller competitors might struggle with.
Exactly. Smaller, under-resourced competitors simply cannot afford the global infrastructure, the dedicated compliance teams, the legal resources required to navigate this fragmented regulatory landscape effectively. Regulation inherently favors large, established incumbents like Evolution, who can treat compliance as a global feature, not some afterthought. It solidifies their market position by basically filtering out anyone who can't meet that extremely high bar.
So, okay, we've established this picture of a structurally dominant business,
Yep.
superior margins, multi-layered moat. Yet the stock is trading like I don't know, a troubled manufacturer.
Hmm.
Which brings us back to the market's anxiety. And that anxiety seems entirely rooted in the recent performance figures, particularly that Q2 2025 report. Headline revenue growth of just 3.1% or, okay, 8.8% in constant currency. Still, that is a dramatic and very noticeable departure from their historical norm, isn't it?
Oh, absolutely. The market looks at those single-digit numbers and immediately thinks deceleration, saturation, maybe the magic is gone. But if we really unpack the sources, much of this deceleration appears to be either strategic, operational, or temporary, which is exactly why the contrarian thesis believes the market is fundamentally mispricing the risk right now.
Okay, let's tackle cause one. Strategic regulatory compliance. Management calls it European ring fencing. What exactly was that, and why did it hit revenue so hard?
So ring fencing was a deliberate, proactive decision by Evolution's management team. They recognized that continuing to service certain legacy, or let's call them gray, markets jurisdictions that weren't yet fully regulated or where local licensing was maybe ambiguous posed a massive long-term
A
risks.
risk to their main licenses.
Exactly. Servicing those markets generated short-term revenue, sure, but it put their licenses in major high-value regulated markets like the UK and New Jersey potentially at risk down the line.
So they essentially chose to turn off the taps, cut off revenue streams from those risky gray markets to safeguard their long-term position in the really important Tier 1 regulated jurisdictions.
That's precisely it. It was a choice to prioritize reputation and long-term compliance over hitting short-term growth numbers.
And they were open about the impact.
Very transparent. They stated this decision had a larger financial impact than anticipated in the immediate short term. But strategically, you have to see it as a profound moat-building move. They consciously sacrificed temporary higher-risk revenue volume to solidify trust with the most important global regulators.
So it's a strategic cost, short-term pain for long-term stability.
That's the argument. And the market seems to have fixated on the missing revenue numbers without maybe fully appreciating the strategic value of the regulatory goodwill they were simultaneously building up.
Okay, cause two is the persistent issue of Asian cybercrime. This feels less strategic and more like an ongoing technical headache for them.
It is a massive, costly headache. This is an ongoing battle against really sophisticated criminal cyber activity, where these pirate organizations hijack and illegally rebroadcast Evolution's high-quality game streams, completely bypassing the regulated operator payments.
Stealing their feed, basically.
Yeah. And this has been a recurring drag for several quarters now, suppressing growth in a region that has extremely high long-term potential. Management has been pouring resources into countermeasures, though.
Any signs of progress?
While Q2 did show a tentative return to sequential growth in Asia as some new security protocols were deployed. But the challenge here is it's an arms race. The pirates evolve just as quickly as Evolution's security does. It's a tough fight.
Right. Let's move to cause three, the internal operational snags. This covers studio undersupply and that significant Georgia strike.
Yeah, these were real issues. During and immediately following the pandemic, demand just accelerated faster than Evolution could physically build new studios and train new dealers. This created a genuine capacity bottleneck.
So they couldn't meet demand.
Effectively, yeah. To manage the undersupply, they were forced to prioritize their highest value, highest stakes dedicated tables, which unfortunately meant reduced availability or maybe longer waiting times for new, lower stakes players. That's a temporary friction, but it does impact the customer experience and retention.
And then the Georgia strike happened on top of that.
Exactly. That compounded the problem dramatically. The Georgia strike in 2024 sounds like it was a brutal operational distraction right when they needed to be focused on expanding capacity.
How bad was it?
Well, their major hub in Georgia was hit by this union strike, which led to the facility running at only about 60% capacity for a significant period. That temporary revenue loss, coupled with all the management attention required just to solve the labor dispute, it caused immense operational distraction globally.
So a classic example of a one-time operational issue, perhaps being misinterpreted by the market as a structural flaw in the business model itself.
That's how the courses frame it, yes.
Okay, and finally, cause four, the undeniable drag, the RNG acquisition drag. Even management has admitted the slot segment has delivered, quote, disappointing organic growth.
Yeah, this one is harder to spin positively in the short term. The intention behind buying Netent, Red Tiger, and the others was sound build that comprehensive one-stop shop, but the execution of the integration, particularly unifying all those complex legacy platforms onto their new one-stop shop, or OSS platform, it's been challenging.
Causing disruption.
Definitely caused short-term disruption. You had some players temporarily losing access to their favorite, maybe niche games from the acquired companies, which led to churn. This segment has just consistently failed to hit management's own stated double-digit growth targets, and its struggles have really anchored the entire group's overall growth rate.
And here's that fascinating connection to incentives we noted earlier. The share price drop resulting from all this actually made the exercise price of the 2025-2028 management warrants set around SEK 870 seem more achievable.
Yeah, it's an interesting, maybe subtle point. A lower, more achievable warrant target price might subtly incentivize management to focus less on chasing perhaps unrealistic, hyper-aggressive growth numbers, the kind that necessitated risky acquisitions and breakneck expansion, and more on just disciplined, profitable execution.
So potentially aligning management more with high-margin durable compounding rather than just short-term high-volume expansion.
It's a potential positive side effect, yeah. A subtle but perhaps powerful signal of alignment towards sustainable value creation. Okay, so the market narrative, focused entirely on these temporary headaches we just discussed, might be missing the forest for the trees. If we assume, as the bullish thesis does, that the strategic challenges are managed correctly and the operational issues get resolved,
Which seems plausible given their track record.
then the narrative could quickly shift back to durable, long-term growth. The sources point to four massive drivers that are expected to really propel the business forward. These underpin a base case projection of, say, low teens revenue CAGR, but potentially a highly attractive 33% share price CAGR by 2030.
Okay, let's hear them. Driver one is the elephant in the room, the North American gold rush. The U.S. market is still, absolutely in the early innings of regulation, isn't it?
Oh, completely. It's still fragmented, incredibly nascent. Regulation proceeds state by state, and currently only 7 states are actually live with online casino gaming. But Evolution is perfectly positioned.
Why, perfectly.
They are the default B2B partner. They're already live in all 7 regulated U.S. states, benefiting immensely from their established compliance track record and existing relationships. North America was actually a standout performer in that challenging Q2 2025, showing strong 23% year-over-year growth. It demonstrates the runaway success they have when a market opens up.
And every single new state that regulates that represents a multi-year growth runway, virtually guaranteed for them.
Absolutely. The regulatory process takes time, of course, but states like Georgia, Minnesota, Illinois, they're showing promising legislative movement.
Yeah.
When these states finally flip the switch, Evolution enters day one as the established market leader with proven infrastructure and a compliant product suite ready to go.
We're talking potential multi-billion-dollar markets here that are still largely untapped.
Exactly. Decades of runway for growth, potentially just from the U.S. rollout.
Okay, driver 2 involves the new frontiers, LATAM and Asia. 2 very different regions, but both critical to the next growth wave, according to the sources.
Let's start with LATAM. You've got a massive, highly engaged population there, and it's rapidly moving towards sensible regulation. The launch of Evolution's new state-of-the-art studio in Brazil looks perfectly timed.
Timed for Brazil's regulation.
Yes, time to capitalize on Brazil's long-awaited regulation, which is expected around January 2025. And LATAM has already proven its appetite. It accelerated the fastest year-over-year in 2023, growing over 44%. That new studio gives them operational efficiency and local expertise right as the massive Brazilian market finally opens up.
And then Asia. Despite the cybercrime headaches we talked about, there's a landmark strategic move there too.
Yes, the opening of their first ever Asian studio in the regulated Philippine market. This is a crucial strategic beachhead. This action strategically reduces their reliance on those older, higher-risk gray markets and establishes a stable, regulated operational base right there in the region.
So management is shifting capital away from uncertainty towards durable, regulated revenue streams.
That's the strategic read. It's a long-term play to legitimize their entire Asian operation and create a kind of regulatory safety net for future growth there.
Okay, driver 3 is innovation widens the gap. The constant stream of unique content is what fuels that network effect we discussed.
Absolutely. The relentless product pipeline is a core part of the Moat. They have over 110 new games planned for 2025 alone. This continuous stream ensures that operators always have fresh content to engage players, and it just reinforces Evolution's indispensability.
And again, the Hasbro deal fits here.
Perfectly. We have to underline the strategic weight of that Hasbro licensing deal. That unique IP simply cannot be replicated by rivals, keeping that barrier to entry nice and high.
Furthermore, there was the acquisition of LiveSkins Holdings. That signals a push into entirely new entertainment formats, doesn't it?
Exactly. Live Spins allows players to actually bet alongside popular streamers in a B2B social streaming format. This is Evolution looking beyond the traditional live table and moving into the burgeoning social wagering space, merging gaming content with social entertainment and influencer culture. They're trying to define the future of the product, not just optimize the present.
Very interesting. And finally, driver 4, the RNG turnaround potential. If the slot segment has been such a drag, any improvement here is basically pure upside.
It's significant, underappreciated upside, I think. If management can simply stop the operational disruption from the integration, streamline that acquired RNG portfolio, and return it to just a modest market rate growth, say low double digits, it removes a substantial anchor on the entire group's growth rate.
Because the current low valuation already reflects the RNG segment being a disappointment.
Pretty much, yes. Any success in improving integration, leveraging their OSS system effectively, and maybe cross-selling their slot titles to their huge base of 800-plus live casino operators, that will immediately boost the total growth picture without requiring another massive capital injection. It's found money, in a way.
Now we arrive at the numbers, the financials that really define this company's uniqueness. Let's just reiterate the profitability because it's staggering. Evolution is a financial outlier, an absolute cash-gushing machine.
It really is.
We are talking about 70% plus EBITDA margins and net margins that consistently push above 55%. This isn't just high, this is rarefied air for basically any industry, let alone the highly competitive gaming sector.
Yeah.
And you contrast that with their balance sheet. They operate with a pristine net cash position of approximately negative $707 million.
And this extreme profitability and cash generation capacity, it allows for a highly disciplined and exceptionally shareholder-friendly capital allocation framework. Management has a very clear priority structure.
What's the first priority?
First is organic growth investing in new games, new studios, which fuels that core engine we talked about. Second is dividends, with a stated policy of distributing at least 50% of net profit back to shareholders.
And then, crucially, after any opportunistic M&A, their primary focus for capital return shifts to share buybacks. They've actually committed to returning 100% of all excess cash flow via repurchases.
And they are executing on this commitment aggressively. They completed a significant EUR 400 million buyback program in 2024, and they've authorized an even larger EUR 500 million program for 2025. This is a huge signal, especially at the current depressed stock price.
Why is it such a strong signal? Buying back shares at these levels is highly accretive, right? Walk us through that quickly.
Okay, yeah. It's simple mathematics, really, tied to that valuation disconnect we keep mentioning. The company is generating earnings that imply structurally a much higher market valuation. Let's say, hypothetically, 18 times EBITDA is fair value.
Okay.
If the current market price is only trading at, say, 10 times EBITDA, the company is using its cash, which is implicitly valued by them at maybe 18x, to retire shares that the public market is only valuing at 10x.
So they're buying back shares cheaply, using highly valued cash.
Exactly. Every single share they retire closes that massive gap, instantly boosting the earnings per share, EPS, for every remaining shareholder. Management is effectively recognizing that their own stock is the best return on capital available to them right now. It's a huge vote of confidence in the intrinsic value.
Speaking of management, we need to discuss alignment. We know the CEO, Martin Carlson, has been the operational leader since 2016. But perhaps the most powerful piece of non-financial data we have recently is the insider buying.
Absolutely. The massive insider buying back in June 2025, where management collectively purchased over SEK 33.6 million, that's about 3 million worth of shares, directly on the open market. That is a powerful bullish signal.
Especially given the negative sentiment at the time.
Precisely. When the people with the absolute best possible visibility into the operational headwinds, the regulatory complexity, the future product pipeline, when they use their own personal capital to buy aggressively while the general market sentiment is negative, it speaks volumes. It's a profound vote of confidence that management sees this value disconnect just as clearly as the contrarian sources do.
Which brings us squarely back to the core contradiction, the valuation anomaly. How does a business with this level of structural quality and a pristine balance sheet trade so cheaply?
It's the key question. The stock currently trades at a depressed placing. Next 12 months, NTM EBITDA multiple of around 10.4x, and a price-to-earnings PE multiple somewhere in the low teens, maybe 12 to 14 times trailing earnings, TTM.
And how does that compare to peers?
Well, let's put that in context. High-quality, maybe more diversified gaming peers like Aristocrat, they trade at 17 to 18 times EBITDA. So the highest quality asset in the entire sector, the one with structurally superior margins, arguably an unbreachable moat, and a massive visible growth runway, it's trading at a significant discount, or only marginally above its structurally inferior competitors.
So the market isn't pricing Evolution like an infrastructure provider or a high-growth technology company at all. It seems to be pricing it more like a slow-growth, mature manufacturing or maybe services business that expects significant margin compression ahead.
That's exactly the insight from the sources. The market appears to be pricing temporary complexity as if it were structural failure. The analysis shows that even if Evolution only achieves a modest consensus long-term EPS growth rate of 13.5%, which seems entirely achievable even if they just hit the low end of their geographic expansion targets, the PE ratio would mathematically compress to an unusually low 7.4 times in just 5 years.
If the share price remains stagnant.
Exactly, if the price didn't move. That strongly indicates the market is either grossly underestimating future earnings potential or it's actively anticipating some kind of catastrophic, permanent margin collapse that the current operational data simply doesn't seem to support.
Okay, before we wrap up this deep dive, we absolutely must perform the pre-mortem. If this contrarian investment thesis fails, if the stock remains stuck in the penalty box, what exactly went wrong? The sources highlight 4 major, non-trivial risks we need to consider.
Right, it's crucial to look at the downsides.
Risk 1, regulatory strangulation. The bullish assumption that regulation acts as a moat proves entirely wrong. Instead, governments, perhaps even coordinating globally, implement hostile measures designed specifically to extract higher taxes from the industry.
This is the risk that directly attacks their core B2B unit economics. The current model, as we said, relies heavily on a revenue share, or GGR commission. But what if regulators implement a turnover tax?
Explain that. How's it different?
A turnover tax is applied to the total amount wagered, the total handle, regardless of whether the casino actually wins or loses money on those bets. It completely destroys the B2B margin model instantly.
Because the tax burden shifts.
Exactly. It would transfer the regulatory financial burden away from the casino operator, who manages the player risk, directly onto Evolution, the infrastructure supplier, who has absolutely no control over player behavior or individual game win-loss rates. That specific change could potentially destroy the high margins and the operational leverage we spent so much time celebrating earlier.
Okay, that's a big one. Risk 2, permanent Asia failure. We assumed the cyber attacks were a solvable arms race, but what if they aren't?
Right. If the battle against these sophisticated cyber attacks proves ultimately unwinnable, or if the hostile operating environment just means their streams are perpetually pirated regardless of countermeasures, then revenue from that whole region may never stabilize or recover properly.
And that big investment in the Philippines.
Exactly. Furthermore, the massive strategic investment in that new regulated Philippines studio could end up being written down as a failure, permanently impairing the long-term growth story in what should be the fastest-growing continent for them.
Okay. Risk 3, moat erosion and customer concentration. We've been arguing that the moat is practically unbreachable, yet the sources point out the top 5 customers account for a massive 41% of Evolution's total revenue. Is that concentration risk actually the biggest vulnerability?
It's a very fair question to ask.
I mean, what if, say, 3 of those major operators pooled their resources? Couldn't they effectively try to force price concessions, or maybe even try to fund and build a good enough competitor?
That concentration risk is definitely real, and it's non-trivial. If a consortium of large operators decided collectively to shift significant volume to a new, well-funded competitor, maybe a good enough product built by some deep-pocketed tech giant, it could potentially slow down that powerful network effect.
So while it might still be commercial suicide to deplatform Evolution entirely,
Right. But this kind of move could trigger intense price competition for market share, leading to gradual margin erosion and seriously challenging that 70% EBITDA figure over time. It's probably the most plausible scenario for a successful frontal assault on the fortress, however unlikely it seems today.
And finally, risk 4, reputational meltdown, the big one.
This is the catastrophic risk that could potentially trigger the other 3. A major high-profile scandal, perhaps tied historically to past gray market operations, maybe allegations of money laundering or widespread problem gambling issues linked back to their platform, could trigger extensive license reviews in their core regulated markets like the UK, Malta, or New Jersey.
And operators would have to react.
Operators, desperate to protect their own Tier 1 licenses and their brands, would likely have no choice but to distance themselves, potentially deplatforming Evolution's content almost overnight. A cascading loss of revenue and trust globally would inevitably follow, which would be incredibly difficult, maybe impossible, to fully recover from.
Okay, so those are clear, non-trivial risks. Despite them, the triangulated valuation scenarios presented in the sources still paint a pretty compelling picture for potential long-term returns, don't they? They seem to highlight the degree of safety offered by the current depressed valuation.
Absolutely. Even in the bear case scenario outlined, where the current slowdown lingers, regulatory pressure remains high, and the company only achieves, say, a 9% revenue CAGR and margins compress to 63% EBITDA. Even this extremely conservative scenario still yields a potential 15.1% compound annual growth rate return for shareholders by 2030.
And that's driven mainly by the low starting valuation and buybacks.
Almost entirely, yes. The low starting point and the aggressive share buybacks provide a significant cushion. Now, the core conviction, the base case, the compounding machinery accelerates, assumes the temporary headwinds clear up and the company achieves a more durable 15% revenue CAGR, maintaining robust 66.5% margins.
Which implies
This warrants a moderate 18.0x exit multiple, according to the sources, implying a target price of around SEK 3,597 by 2030. That's a whopping 33.0% CAGR from current levels. And then, of course, there's the bull case, assuming flawless execution in the U.S., a rapid turnaround in RNG that projects a 20% revenue CAGR and potentially a 45.6% CAGR return. Hashtag TED outro.
Okay, so the verdict derived from this deep dive analysis seems pretty clear. Evolution AB looks like a genuinely world-class business, currently trading, as the sources put it, in the market's penalty box. The market appears to be fixating on temporary strategic challenges like that European ring fencing and the recent operational snags.
And perhaps failing to correctly differentiate transitional complexity from fundamental structural decline.
Exactly. The underlying structural foundation, that unparalleled scale, exceptional profitability, massive cash flow generation, and those vast defined growth runways, particularly in North America and regulated Asia, it all remains exceptionally solid based on this analysis.
So the central question for you, the long-term investor looking at this, it really boils down entirely to patience and conviction. Do you believe the structural dominance of this unique infrastructure provider, which has clearly built an almost unbreachable moat based on scale, network effects, and unique IP? Do you believe it can and will overcome this period of short-term operational complexity?
Because if you do,
If you do, then the current period of market uncertainty and undervaluation might very well be, as one source provocatively put it, the last best chance to own this compounding machine before its next chapter of inevitable, durable growth driven primarily by North America and a more regulated Asia becomes so blindingly obvious that the market reprices it rapidly for everyone else.